Now, Bloomberg News reporting exclusively that banks are boosting lending to buyers of high-yield loans as well as mortgage bonds at what may be the fastest pace since the whole credit crisis began to unfold back in 2007. Okay, so why the change? Well, Marty Fritzen is an expert in the high-yield arena. He is the CEO of Fritzen Investment Advisors. Marty Fritzen, good to have you with us. Thanks for coming in. Now, the issue facing, one of the big issues facing high-yield investors is default risk, right? Everyone worries about companies defaulting on their obligations. And there has been this kind of conventional wisdom out there that says that default rates are rising, so everyone gets worried. You're saying, hey, wait a minute, right? What have you found?
Well, the reason that the conventional wisdom has set in is because that's what the media is reporting consistently, and it's not wrong in the sense of the way the statistics get reported generally. What you see reported is a trailing 12 months figure, simply the number of companies that were in the universe of speculative grade bonds at the beginning of the period and what percentage of them defaulted over the next 12 months. The problem is that when you have a huge spike, as we have in the past year, and then an equally sharp drop, you got a distortion in that trailing 12 months figure. As you can see in this graph, the number of defaults has been falling month by month. It's actually down 60% from a peak in March. So why does the default rate that you see talked about keep going up, and why is it projected to rise even further to a peak of about 12.2 according to Moody's, and the other agencies have even higher figures? Well, that's because as the new month comes into the picture, the old month that drops out turns out to have had a lower default count a year ago, ancient history really. But for example, in the latest month, as July number came in, there were only 16 defaults. That was down by a third from June's 24, but it turns out that July of 2008, which fell out of the series when July of 2009 came in, had only 10 defaults. So the 12 months.
So it looks really bad because it's the way the math is being done. I mean, it's sort of like data masquerading as information.
Yeah. There's some good reason to have a smooth series. 1 month's worth of data can sometimes be a little bit too volatile, but you really don't need a 12-month series to take that out of it. So the impression is very different from the reality. I mean, month to month, the defaults have been coming down very sharply, really for the last 6 months.
All right. So if the number of defaults is coming down sharply, and yet we keep talking about how the default rate is rising, there's got to be an opportunity in here for investors, right? So yeah, what should they be doing?
Oh, I think they should be taking advantage of it, and we could have a pullback in the short term over the next year. I think you're going to look at very good returns, which surprises people as well, because we've had a 39% return year to date from a very low bottom around the end of the year. So it might be surprising to expect to see mid-teens returns over the next year, but that's actually what has happened in the past following peak cyclical years in the high-yield market.
So the situation is, don't kid yourself, don't not buy high-yield bonds because you think the default rate is increasing. I mean, you might not buy them for a lot of other reasons, but that's one that you should throw out because the statistics, the actual information is showing you something different.
Yep, that's exactly right.
And are institutional investors, I mean, are they getting this, or are they still stuck with this whole rising default rate concept?
I think some of them are being swayed, particularly if they're not specialists in this area. If you're reading repeatedly that the default rate is going up, and there are a lot of other good investment opportunities out there, it just might not be the one that you'd focus on. Now, if they take the time, they would certainly understand it. And
or if they listen to you and read your reports.
Well, that could help as well. But one way or another, I think they would get it. But again, if there are other opportunities that also look attractive, they may just not focus on it and take the time to get the real story.